that's kind of your target as well, isn't it?
Yeah, it is our target, and I think what we've seen, we've seen a real sentiment shift over the course of the last couple of weeks, and you could argue Mario Draghi started it maybe in first talking about the need to sort of remove accommodation and talked about the tapering of their purchases, so it changed the sentiment. And we would agree. I mean, the underlying fundamentals of the US economy are solid, right? They're not exceptional, but they're solid, they're broad-based, and, the Fed is on this move to continue to raise interest rates, and of course we expect to get details around their tapering program as well. We think in September. There is some chance, we obviously saw the minutes this week, some chance of July, we wouldn't rule that out. So there is a sentiment shift. The bond market is telling you the world is getting better and that central banks need to start removing accommodation, right? And so I think that's what's going here. So yesterday was an interesting day, but got the chart behind you there, jump above 50 basis points on the bund. Long time since we've seen that. So yeah, markets are moving.
Andrew, your target is for about that of Gundlach's. Gundlach's target is not new. He's said this before, and of course right now he's just talking his book. There are others though who see it yields going lower. Steve Major, I think, is looking for 1.35% or so. Of course, that's what makes a market. But what are the biggest risks to a 3% yield? I mean, what could push us lower rather than continue higher?
Well, I think to have a yield of close to 1% on the 10-year Treasury, you'd have to see a US recession on the horizon. We don't see it. There's nothing in the numbers that would suggest it's anywhere near close. So, I think the move higher in yields is a reflection of the stronger economy, of the improvement in the labour market. We'll get an update on that, of course, later today. So, I think in terms of yields moving higher, if it's off the back of solid growth and maybe even some uptick in inflation, that obviously is the big conundrum here. We can talk about that, I'm sure. But, if it's off the back of better growth, then I don't think it's such a big problem. Now, a lot of it is the speed with which it happens. And I think the talk we've heard from all of the major central banks is trying to get the notion out there without causing a lot of disruption. Now, it's a very fine balancing act that they're trying to perform here to say, yes, we're going to be removing accommodation, but it's going to happen slowly, it's going to happen gradually. Markets are reacting, obviously, much, much sooner.
Yeah, I think to be fair to Steve Major at HSBC, I think he's moved his target up to 1.9%, so he's closer to kind of 2% now. But he does still have a downward expectation, and there's a whole bunch of factors in his thinking. What is going to be the effect of the balance sheet unwind? Because we kind of roughly understand how it's going to happen. Is it either or when it comes to rate hikes or balance sheet unwind? There are still a bunch of imponderables that sit around this story.
Yeah, look, it's well known. So they've outlined the schedule. We don't know when they start, but they've told us over the 5 quarters exactly how much they're going to run off on the balance sheet. So you would expect it not to be a huge event in of itself. But I think the combination of further rate hikes, which we would say the next one is likely to be December, as well as the projection of 2018 and saying...
So where are you in 2018? Where do you...
We think 3 hikes, possibly 4 in 2018. So we're pretty close to what... That's exactly
that's what the dots are saying.
Yeah, that's what the dots say.
The market isn't, though.
The market isn't, and that's the interesting piece, right? So I think that's where we need to get to, and, numbers like today need to be firm to confirm that, yes, the Fed is on track to raise interest rates. So that's why we get kind of so excited about watching payrolls. Are we moving in that trajectory? And therefore, is the other dots more likely to be right than the market? We would go with the dots.
Andrew, to what extent could geopolitical tensions hurt, your forecast and also the Fed's plans to raise rates? I mean, if, for example, the U.S. and China start to really get into it over North Korea, could that be a problem for U.S. rates?
Well, geopolitical is always a really tough thing to try and calibrate the impact it has on markets, right? So if the event is serious enough, then of course, for some time, it disrupts markets. We get volatility, and if the event is obviously not very good, bonds tend to rally. But those tend to be relatively short-lived. So unless it's something really major, we would say it causes some volatility, maybe has some short-term impact, but doesn't really derail the economy. And it's hard to imagine that something like North Korea could really escalate to the point where it had a material downward impact on the US economy. So short-term, yes, certainly the potential for volatility. Longer term, I think the Fed is very much on course. We would describe the Fed as being pretty resolute about removing accommodation.